So as you can see, it's Maithan Alloy. The name itself says it's an alloy-based company, which means it is related to commodities. So the first question which comes to my mind when I heard about Maithan Alloys and when I saw the numbers of Maithan Alloys was, is it a quality company or is it a commodity company? Because we do have our notions of quality based on certain numbers which companies reflect. But given the kind of sector the company is present, I think that was the most important question which hit me, and I will explain why. Because when we think of any quality business, the typical things which comes to our mind is sustainable growth, decent return on capital employed, low leverage, ethical and able management, which has been able to execute over the years. This is how typically we associate a quality business. Now, when we think of a commodity business, usually it will represent the growth will be volatile, the margins will be volatile, the return on capital employed will be low. These kind of companies will be highly leveraged companies, and sometimes even the management is also unethical and non-performing. Especially, when the business is poor, and we have discussed something about this in our fundamental analysis course when we discuss the management section. That is one of the course we run. So these are the typical characteristics of what is a commodity business. Now, how about looking at these numbers? And these numbers, of course, because we are discussing about Maithan Alloys, these numbers belong to Maithan Alloys. And if we see last 7 years of sales CAGR, they have 17% sales CAGR for last 7 years. They have 28% PAT CAGR for last 7 years. They have 27% average return on equity for last 7 years. Currently, they're a debt-free company. They have been able to convert most of their PAT into cash flow from operations. And finally, they have been able to convert 76% of their cash flow from operations into free cash flow based on last 10 years of history. Not only this, there is 0% promoter pledge. There is a significant holding of promoter, almost 75% promoter holding, indicating skin in the game. The company has been able to grow more than 3x of the industry growth, where the 17% sales growth has been almost 3x of the steel cycle growth, which is basically the industry in which they operate. And the company has more than 40% of current market cap as cash on books, and the company has given a CAGR returns to investors of more than 26% for last 10 years. So these numbers are like numbers to die for. Like typically when we talk of quality business, this is where we see these kind of numbers. But here is a number reflecting in a steel kind of business. And 7 year, 10 year, these durations are not smaller duration. These durations do capture a complete cycle of the commodity. And currently the stock trades at 5.28 EV EBITDA basis. So when I analyze this stock 2 years back, and even when I think of this stock, always the biggest dilemma remains, and the biggest curiosity and the learning remains is uh, how market perceives these kind of stocks, how the perception of market changes. Does market treat it as a quality stock? Does market treat it as a commodity stock? Does market treat it somewhere in between? Why the market treats it that way? And if a business is a quality business versus a commodity business, the kind of valuation gaps which could be there, it could be humongous. So the whole idea is to understand the company in detail and build our own perspective of where we should place it. So with that, let's try to address this question. Is Maithan a quality stock or is it a commodity stock? And again, I'm just highlighting the definition of quality based on some of the financial numbers. These may not be the standard definition, but this is how we perceive quality, and hence I have used that. So let us try to understand this from the business side, and we will cover this in 6 sections. We will start with the company and business introduction, followed by a financial analysis, then detailed business analysis, and then we will proceed with valuation analysis, risk analysis, and summary and key insights. So in this video, I will cover up to business analysis, and we will cover valuation and rest of the analysis in next video part 2, because else it will be too long, it will become boring. So starting with the introduction of the company. So the company basically, they are in the ferroalloys space. Now alloys are something which enhances the strength and the durability and the anti-corrosive power of the steel. So basically they are used in steel manufacturing to improve the quality of steel by improving its strength, durability and all. And then ferro alloys, they come in various types like ferromanganese, which is a alloy with iron and manganese, silicon manganese, which is alloy of silicon and manganese, or ferrosilicon. So these are the different variants of ferro alloys, and the uses in steel differs little bit, and their uses, it differs little bit. So Maithan is present in primarily in manganese alloy, in ferromanganese, silicomanganese, and ferrosilica, and they have almost 10% domestic market share and 2% international market share. They also want to get into chrome alloy, where they plan to build a new capacity for chrome alloy, and they are present through three different units, where Vishakhapatnam acts as the export unit, and remaining two are they are the domestic unit. And if we see the revenue spread in terms of domestic versus export, it is almost evenly spread. And export is basically in Asian countries, excluding China, which is the biggest market, and the reasons why they have not entered into China. And also, it is evenly spread between ferro and silicomanganese. And when we think in terms of raw material, almost 50% of the raw material of the variable cost raw material is manganese ore cost. 30% is 30% is power cost. And these are some of the clients of the company, like Sale is one of the biggest client, Jindal is there, POSCO is there. However, no client is now currently more than 10% of the overall revenue. Also, a little bit about the promoters. So the company is promoted by Mr. S.C. Agarwala, and he, along with his two sons, Subodh Agarwala and Sudhanshu Agarwala, they run the company. And both the sons, they have a good education background with BTech and MBA degree from IIM Bangalore. And Sudhanshu Agarwala, he has MBA degree from XLRI Jamshedpur. So these are decent education backgrounds. If we look at the salary of the management, the salary does look on the higher side. Like if we add, we see almost 2009 salary, almost 16, 17 crores of salary. But the good part is the salary is variable linked and performance linked. And in years when, because it's cyclic business, years when there is no growth, the management has also not shied away from taking lesser pay. Now I'm not getting into detailed business analysis. I'm getting into financial analysis because we started with those numbers. So let's relook at these numbers in detail, and let us see what are the numbers which really stand out and what are the numbers which are of concern. And then we'll try to get into business analysis, and we'll try to decipher those numbers and see what are the reasons why these numbers are good or why some of these numbers are bad. So this is a complete analysis of the stock in terms of their 8-year history. Whether we talk about P&L, we talk about balance sheet, we talk about cash flows. So let me just explain these numbers. So this number row is based on the 8-year history. This row is based on 5-year history. This is on 3-year history, and this is 1-year history. And we have taken the FY20 March numbers because FY21 March numbers are still not available, and we wanted to take annual number. So on an 8-year basis, they have grown their sales CAGR at 13%. On 5-year basis, it has grown at 10%. On a 3-year basis, it has grown at 11%. And last 1 year, it has grown at -8%. Obviously, COVID being one of the reasons. So same way, you can study each of these numbers, and we can see whether it's sales, it's EBITDA, it's PBT, it's PAT. The company has done reasonably well. Off late in last 3 years, it has been in mid single digit. But still, these 3 years does include the COVID year. So if we include COVID year, still this number would have been, more than 10%. And given we will see the steel cycle how it behaved. but the steel cycle did peak out in 2016-17, and after that it has been a little poor, and that could be one of the reason. But still, if we look at the long term history in terms of a full cycle, these are like very very good numbers, whether we look at sales or we look at EPS or we look at cash flows. Also, the working capital, though it is on higher side, it has been around 30 to 40%. And if we look in terms of the absolute numbers, the numbers look decent. The PAT to cash flow conversion has been good. Uh, the company is distributing dividend. The cash flow looks minimal, and that is interesting because a lot of this growth has come without extensive cash flow, which is very untypical of a commodity business. And the company is throwing a lot of free cash flows. So if you see the cash flow to PAT ratio or free cash flow to cash flow ratio, these ratios are very very healthy. And also, if we see in terms of receivables ratio, inventory ratio, these numbers are also decent. Now, if you want to know what each of these ratios mean, uh, I would request you to Google a bit, because we can't cover a lot of these things. But again, we run some of our courses. There are courses related to fundamental analysis, where we cover a lot of these basics in detail. Also, if you look at the margins like gross margin, EBITDA margin, PAT margin, inventory days, debtor days, the numbers, though they are a little bit cyclic, but still they look decent, and by no means they look like a typical commodity company where the even the worst case of the scenario, the company has never made losses on an annual basis, and you can see the PAT margin was 1%. But yes, the gap between the min and max is huge, which says maybe on a specific year basis the fluctuations could be very high, though on a 3, 5, 7 year basis the numbers look decent. And if we try to analyze all of this, we see the growth rate has been very good, both in terms of top line and bottom line and cash flow. This looks like asset light business because it's a debt free business, not a lot of capex required, and there is a lot of cash on books. Excellent free cash flow to sales ratio. So it's not only about cash flow from operation, even the free cash flow is very very good. The return ratios in terms of return on capital employed, if you look at the ROE, ROC, and all, if you see the min max, of course, because of cyclicity, certain specific years these numbers might be poor, but on an average basis these numbers are again respectable. And if we again go back the average 7 year numbers, these numbers are respectable. And the inventory days, cash return on asset, these are also very reasonable. There is one thing which is there. The company operates at around 20 to 22% tax rate. So the question is why the tax rate is lower. Also, if we see the raw material prices, and here it is, if we see the raw material to sales, we can see it has been fluctuating, like from 64% it came down to 50%, and then again from 50% it has gone to 58%, which says there is a volatility in raw material price. And also there is some volatility in the power cost. So the question comes, what is the normalized raw material prices and what is the normalized power cost? Also, if we see, the company has almost 800 crores of cash, but the dividend distributed is not very high, it's very low. So why the company is not distributing dividend when there is a lot of cash on the books? And there is a cyclic component. The growth is cyclic. If we look at the sales growth, so if we look at the sales growth, or if we look at the PBT growth, these growths are not very linear and consistent. It's high in some year, low in some year, which means the growth is cyclic. And even the return ratios, though they look decent in terms of ROE, still we can see there were years when these numbers were around 12, 13%, and then there are years when these numbers are like 30, 35%. Again, it's coming down. So it says there is again some scope of cyclicity in all of this. If we compare this company with respect to competition, so when we compare it to competition, and I have taken IMFA as a competition, and I have tried to analyze last 3 years, 5 years, and 7 years of number. And when we look at PNL, these two companies look very different. If we see the raw material cost to sales, Matham's raw material cost is much higher than IMFA, which means IMFA has some advantage so that it is able to, or either the businesses may not be exactly same, but IMFA has a relatively lesser raw material cost. But when it comes also when it comes to power cost, IMFA has very less power cost compared to Maithan. Maithan has very high power cost. So here it doesn't look favorable, but when we look at the employee cost, Maithan is highly efficient when it comes to employee cost, or Maithan is highly efficient when it comes to other manufacturing cost or even SGA cost. Also, because of its debt-free balance sheet, Maithan doesn't pay much of interest. So hence, its interest expense as a percentage to sales is much lower than IMFA. And because again it's a asset light business, and we will see why it is asset light and how they are managing. Uh, its depreciation as a percentage to sales is again very low. So even if you add the interest and depreciation there itself, it has almost a 10% margin advantage. And the reason being, they have not invested in the ores and mines and captive power plants and all. And that is the reason, it is very low. And even if we compare from some of the other companies, we will clearly see that Mathan stands out when it comes to the most important metric like return on equity or return on capital employed and all. And they have a very good growth also, and this growth is not a growth with poor balance sheet, it's a growth with very strong balance sheet. And currently they are leaders with very respectable market share in some of these products. And they have done almost 5x capacity expansion in last 3 years, and currently they're working at 90, in fact 95% capacity. And they look the lowest cost producer due to higher efficiencies, employee productivity, and SGA efficiency, strong balance sheet. So how it has been achieved, what the company has done different, why this company has been able to do things differently from peers, and that is what we need to identify. And these are some of the questions which comes to our mind when we look either at the financials in standalone, in isolation, or even if we compare the financials with peer companies. So if we look at all the open questions, there are certain questions which highlight the strength of the company marked in green. Like how can the company maintain a strong balance sheet and decent return ratios even at the worst of the cycle compared to peers when the peer goes in loss? Also, how the company is able to maintain the above average 3x industry growth. And we have seen that there is a raw material volatility when we saw the charts related to raw material prices. So how the company manages this raw material price volatility and still able to generate profit in worst of the years. And we have seen the company is sitting on 800 crore of cash. So is there a new capex plan? How it will play out? What will happen to this cash on books? These are some of the questions which raises doubt in the mind. And then there are certain negatives in the numbers, like why there is very high cash component and low dividend yield. Also, there are certain family transactions which happened in 2017, and some of the family members, they have been involved in financial frauds. And we will see what is the relation between these financial transactions which happened in 2017, and what is the fraud which happened with where some of the family members were responsible. Also, it is evident that this business is cyclic with volatility in margin. So, what is a sustainable margin which we should factor in our valuation? Also, if we look at 2014 numbers, and again, let me go back and show 2014 numbers, we can see in 2014 the profitability at a PBT level, it went in negative. So the question is, why so? And when I'm taking PBT, it's based on the core operations without considering any interest on the other income, given they have huge cash on the books. Also, the power tariff in the country is high compared to other countries which produce ferroalloys. So, will it act as a competitive disadvantage given, it's not only domestic competition which comes into picture, and there is some competition from countries like Malaysia and Indonesia. So again, when we try to analyze this business, we will try to look through some of these strength and find why there is this strength. We will try to address some of these issues to see if there are genuine answers to these questions. So with that, we will jump into the detailed business analysis. But before that, I think you saw some of the dashboards we have built, some of the charts we have built. And we use a lot of these things in our financial analysis courses. We have a course for fundamental analysis, which is a 30-hour course with very comprehensive syllabus and curriculum. So feel free to explore our YouTube channel and our resources, and see if it makes sense to you to to enroll for some of these courses. So let's jump to the business analysis, and let's go almost 10 years back in the history. And even when we are dealing 10 years back in the history, let us see how the company has done 5 years before this period, which means we are almost tracking 15 years of history of the company, to understand its genesis, how it emerged, and how it has progressed. And this is from 2010-11 annual report. And if we look that in last 5 years, they have been able to grow their ferroalloy business at 18% CAGR between 2006 to 2011. Also, they were able to grow their export revenue aggressively. They did a 62% CAGR growth in exports, and they were able to increase their export share from 4.29% to 43%. Not only they expanded and grew their export, they were also able to build more value added products, and they improved their realization from 30,800 rupee per metric ton to 61,800. Now this can have some kind of seasonal and cyclic component, but still 100% increase looks decent. And they engaged with top four of the five global steel producer companies through repeat orders. And the company had aggressive plans to double some of the capacities, which means they will become almost 32% share in next 2 years. Also, it explains that the product which they are manufacturing, 1 ton of steel requires only 12 kgs of manganese alloy, and this manganese alloy required is just 1% of the total manufacturing cost, which means for its customer this cost is a very 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 minimal cost. But still, the product is very important, because even if there is a small percentage of impurity of manganese alloy, it can affect the quality of steel manufactured. So the amount of money involved is lesser, but the quality aspect is involved. And that is where Maithan they focuses on reducing the carbon, phosphorus, sulfur, and other impurities by 40%. And that is how they have been able to set high quality benchmarks. And these are some of the reasons they highlight why they have been able to grow better than the industry. And if we look at the performance of the company highlights that they have been able to grow better than industry. And though they say they aspire to become a non-cyclic company in cyclic world, but it is not possible. So the idea is to basically do better than the competition, and that is how they highlight. And in some way, they have done it by reducing the impurity, and by creating some niche products, value adding products, and they have a almost 0% zero product rejection. So it gives a flavor of how the company was doing even 10 years back, and in 10 year how it has evolved in last 5 years from that 10-year time frame. If we go further, we get more insights into how the whole manganese alloy industry works, where 90% of the manganese alloy is used in steel production, which means if we understand the whole value chain, what they are producing, 90% of that is going to consumed by the steel industry. And if we see where the steel industry gets consumed, this is the distribution of steel industry. So if we start from their product, we know their product will be used by steel industry, and steel industry will be used by automotives and capital project and pipes. So ultimately, it's very very difficult to make a projection, because if one of these industries doesn't perform, it impacts steel. If steel doesn't perform, it impacts them. So this whole cycle is there. And same way it is there with ferroalloys also. Also, if you see, China is almost 50% of the world production, and they don't operate in China, which means 50% of the market is totally, at least as of now, it's not their target market. So even if we think of the market size opportunity and all, I think we should remove this 50% and we should build a market size opportunity more on this market. Now again in this, we will see in further sections, there are certain market they want to ignore. which is good because they know, rather than targeting everybody, they're very focused. They know where they want to target and where they don't want to target, and we'll see some of that. Going further from 11, 12 to 12, 13, now 13, 14 was, we saw the margins almost went in negative. And I think it was one of the worst years for them and for the industry in last 10 years. And despite of that, in a year also, in 3 quarters, they were able to, maintain some positive profit. And they tried to, strengthen by entering into new geographies. They further deleveraged their balance sheet, and they could somehow maintain their realization around the same level. But the next year, when the tide turned, we can see, against a 8.5% revenue growth, they almost more than doubled their profit. And that is where some of this operating leverage it comes into picture. And also they try to de-risk by going in more external export markets. And they have a client base which they mentioned, like some of the biggest steel companies of India, and they have a repeat relationship of more than 7 years. And one conscious call which they took in 2009, which helped them, was to shift from Europe to Asia, realizing Europe is going to stagnate and it is Asia which is going to grow. So that is why when we are talking about the target market size, we need to get rid of the European countries, we need to get rid of China. And then when we look the target market, at least it will shrink by a good 60-70% margin, which will make the market size opportunity analysis more realistic. Further, when it comes to 2015-16 annual report, it highlights how the company has been able to, maintain such good numbers, remain asset light. And there are a few important things which they highlight, which is, uh, most of the alloy company, they invest in captive power generation and they reduce the production cost, but they don't stress the balance sheet, and they do more through these tie-ups where they don't invest in these assets. And that is why if you see, in the P&L statement, their power cost expenses are much higher than some of the competitors, but then they don't stress on the balance sheet. And because they don't stress on the balance sheet, they are able to save cost on the manpower side, they are able to save cost on the interest side, they are able to save cost on the depreciation side. And then on an overall basis, it is a much more, productive business on return on asset basis or return on capital basis. They are also not very focused on capturing market share. They are more focused on the margins they maintain and the margins they can make. Also, they highlight that they don't want, most of the manganese ore alloy companies find it tempting to play to the ore market, but they don't take positions on manganese ore prices, and they don't keep their sales position open. So there are very interesting insights in the annual reports of last 10 years where, they could have doubled their profit just in 3 months if, they could have kept their position open. But they say it's like playing with fire, and they don't want to, be short term minded. So they try to cover it through the contracts, which means even if there's a big profit price increase, they will not benefit a lot. But when there's a big price decrease, they will not get wiped off. Also, they don't hold ownership of mines to keep their balance sheet light. And again, they work through contracts and they try to keep balance sheet very light. So that is again maybe one reason why they pay a little higher on the, raw material cost side. And also one reason is because they're into value added products. Lot of their raw material is imported, which is of higher price, higher quality. So because of these two reasons, it looks little higher. But then again, it helps them to maintain a very light balance sheet, which helps them in the, bear cycles of commodity cycle. And they try to focus on the margin and, maintain profitability. And again, if we look, like we saw 2010, 11, now if we see 2015, 16, again they have grown at same 15% kind of CAGR in last 6 years, with stable margins. And again in this year, though the revenue grew at 4% because of these kind of operating leverage, there was a 50% profit growth. And they highlight that despite of little tough market, they didn't lose a single customer. They try to get more business from the same customer, and they didn't trade in the raw material. So they highlight that they might miss some short-term opportunities, but it provides relative stability to the business given they can't escape from the cyclic nature of the business. Now, growth they have highlighted in 16 itself. Growth is they have to grow either by two options: increasing the capacity or acquiring distressed asset. And a greenfield expansion, they mention it takes 4 to 5 years to commission and stabilize, where their experience says, because it's a cyclic industry and there is a lot of, uh, lot of cyclic behavior in peer companies, they have been able to, take and acquire a business and stabilize it in a lesser time. So they are more excited about waiting and, playing at the right time, getting inorganic growth deal at their terms and condition, and then turn around. And how they have maintained profit. So again, they highlight that they don't take open positions, they don't get into this kind of short term mindset, and they are more into contract driven, and that is how it do it. So I think this slide explains a lot about why they are more profitable, why they have survived, why they have a strong balance sheet, and why the P&L numbers were different. Also some more insights, like if we look, there have been number of instances where magnesium alloy manufacturers re-engine the sales contract when price moves sharply, whereas they have been maintaining the integrity, and they don't get involved into these things. They get involved into variable contracts, but at a predetermined terms and condition, rather than giving surprise to client. Also, they don't get into resource arbitrage opportunities. They focus more on manufacturing efficiencies rather than doing trading based on the short term nature of the price fluctuation. And they try to get less into spot based contracts and more into long term contracts. And they work more on make to order rather than make to stock, and then, push the inventory. So again, these are some of the reasons why, they have been able to do better, spending less on the, high value capex and all. So again, it reiterates why, they have a better balance sheet, they have a better cash flow, and they are the lowest cost producer of the manganese alloy in the world. And they have been consistently one of the highest margin companies, by despite of producing at lowest cost, because of how they have maintained their balance sheet, how they have maintained their cash flows. And again, if we will see, the company always, if we look at a 4 to 5 year period, the company always does better than the overall industry, and they're able to, maintain the margins. And even the worst case scenario, the margins are still, in the profitable when the competition goes in losses. And again, it reflects this is again a different year annual report, 16 17. But they reiterate they are not for quick growth, or they are not for acquiring any company just to show the top line. For them, the kind of asset turnover a new asset should bring, the kind of margins a new asset should bring, the kind of return on capital a new asset should bring, it is very, very important for them. And they also highlight that they expect to do 14 to 15% sustainable EBITDA margin, though in some of the years they have done almost 22% EBITDA margin, which highlights that, they are not giving false promises, but they are giving a realistic scenario, what is realistic possible, and this could be one of the year. And since 2017, they have been working on 95% capacity utilization. They have been growing cash asset on books, but they are in no hurry to, deploy to get a margin declining, asset. And why this mentality, how this mentality comes, why they are like this. And they highlight in one of the annual reports that they have grown from 30 crore profit in 2009-10 to 255 crore profit in 2018-19. And this is not the best of the year. This is when the steel is in down cycle, else the number was almost 300 crore. But what happened is in 2008-9, and they say the reason has been because they changed themselves. And they get into this, they highlight what happened in 2008-9. There was a sharp increase in manganese ore prices and alloy realization in the beginning of 2008, when the whole crisis didn't happen. And it was a time when the prices were hitting the roof, and it was a time to make very quick money and, earn a lot of profit. We were making very few in a few weeks where our profits were larger than what we made in the previous quarters. But then the Lehman Brothers happened, and then everything crashed, and the manganese ore prices also crashed. And then they reported inventory losses, because they were playing with spot contracts and all. and they were compelled to take the delivery of the contract at this. So in a few days from super profit, they were in a super loss. And that is where they highlight that it was like a easy come, easy go. And that is where, they took that as a lesson and they decided not to repeat it. So the thing was, they realized that businesses are not complex. It's we who make the business complex. If we keep it simple and if we avoid this whole quick profit making thing, and if we distance ourselves from greed, our profits could be much more stable and much more consistent. And that is where they took a call that they won't get into this kind of business, and they will change their business model. And it may sound awkward to a number of people, but when we resolved to repair our business, we engaged in some of the most fundamental things, and they realized the business was right. It's they who are not right because they got into this kind of short term mindset. And that is where they decided that they will do it in a different manner, with a different mindset, without getting into these kind of short term mentalities. And that is where you saw some of the highlights that they get into they don't get into these kind of open contracts. They try to have as much as possible through a pre-decided contract, whether it is about procuring the raw material or about supplying the product. And again, they highlight that it's a commodity industry, and they have been able to grow through a superior product mix by remaining asset light, and they want to repeat the same thing. So they have a growth plan of deploying 600 crore of cash in next 4 years. uh, but again, they want to highlight that they want to do it in a manner which is ensures that they stay the lowest cost producer and all, and they should be able to maintain the 15% EBITDA margin. Also, if we look at some of the con call transcripts, and this is one negative which I have seen, is they don't do this frequently. I mean, it's not consistent, and that is a place where they should work. But based on the 2 3 con calls which they have done, there were questions around high cash and low dividend yield, and their response was they're earning 7% post tax return on surplus plus cash. Also, this cash has been accumulated in last 2.5 years, and I think this is 2018 or 19 con call. So basically, they have accumulated in this cash after 2016, and prior to that, they were a company which used to be in debt and then debt free. Again, capex will happen. Again, they will go in debt. Again, they will clear the debt. But this is one time where they have grown, and despite of not taking debt, and now the cash is piling up in last 2.5, and then again 2 years, almost in last 4 years. And they highlight in 20 years of history, they have grown from almost 10 MVA to 137 MVA, which is 13x growth in almost 15 years, with limited debt. And despite of all this growth, now they are debt free and they became cash positive. And at this point of time, they were almost 275 crore of cash. In fact, right now, I think adding last 2 3 years of cash flow, again they are almost in 830 crore of cash. But they have not deployed it because of the reasons they highlight, that they don't want to do things in hurry. And what they say is, if we are unable to put this cash to good use, we will return the money to shareholders. They asked for 12-month period, but again, not much has happened. But given they are in cyclic industry, they want to be prepared for the worst case scenario and the kind of opportunities which may come. And after that, none of they haven't done any con call. Also on the export thing, they highlight that some says, by nature, because they are getting a tax advantage, it has to export. And also certain centers are gaining better market at export, and that is how they have few plants for export and few for domestic. And on the Malaysia as a competition, they have highlighted that there were years when more capacities came, but those things have stabilized. But I think still we should take a learning that the competition may not come only from India. The competition may also come from low price competitive nation. And they highlight that they give a margin of 15 to 17% as sustainable. And the reason they give that, because of their asset light nature of the business, they have 4% headroom over competition on EBITDA. And when the business competition goes at 8% EBITDA margin, that is the time when competition starts making losses. And at that point of time, they will be at 12% EBITDA margin. So they say the For them, the worst case scenario is 12%, because as the competition starts making losses, some of the competition will go out of business, and again the cycle will turn, and again the good things will happen. So this is where they see the worst case scenario, which is 12%, and on a sustainable basis 15 to 17% EBITDA margin, and then the peak could be somewhere around 20 to 22%. So I would like to highlight that, remember these numbers in mind, because when we do the valuation exercise, what is the worst case scenario, what is the best case scenario, how we build the margins, how we build the cash flow model, it is going to be very, very important. Also, somebody asked in terms of then why 2014 was very poor, because you didn't do a 11% EBITDA margin, you did much lower. And they highlight the reason because that was the year when the Vishakhapatnam plant came, and there are a lot of front end expenses, and it took time to turn around that business, that specific plant. And if we remove that specific plant, then the numbers were still good around the same lines. But because of this plant, the numbers were on the lower side in that worst of the year for steel industry. So this is what they highlight all of this in these con calls. Also, they highlight how they manage raw material price volatility, where they say they have very less contract which is on spot basis, which is the risky, and most of the contracts are 3 to 4 month basis, where which is more on the fixed price, given the fluctuations could be lesser in 3 to 4 months, but still prices fluctuate and there is a cyclicity, and hence their margin also impacts. And then they have contracts which are in longer duration. Now these longer duration contracts are few, but these contracts have a variable clause where based on the steel price index and all, the price varies, and hence they are more secure. And again, in terms of capex, they highlight their plans to come up with the chrome alloys, but they could do with manganese alloys or all, but they're not very sure which they will go. They will decide based on the market condition. Some more information in terms of dividend. So there is a consistent dividend, though dividend is on the lower side. The company has issued bonus twice, almost 75% held by promoters, 3% held by FIs and AIFs, 14% held by individual investors, and this is based on 2019. I need to update these numbers. And there are these are the shareholders, and somehow there was no mutual fund holding. And if we look at the related party transactions and all, it looks very clean. So this middle section is basically all the salaries which management has taken, almost on the 250 crore, 10% comes around I think 25 crore. And if we see for 2019, this is almost around 17-18 crore, which is on the higher side, still within the well within the range and on the variable basis. If we look in terms of transactions with other subsidiaries or enterprise, these numbers on a 250 crore profit, these numbers are not high. This is a CSR expense which is mandated, and these are very small transactions. So it looked pretty clean to me. Not a lot of subsidiaries also, which is typical with these kind of businesses. 2-3 subsidiaries created. So this looks clean, and there are questions around the family, and we will see that when we discuss the risk section. We will see that. So next is valuation exercise, and I will see you in the next part 2 of the video, where we'll do a very detailed analysis of the valuation. We will cover the open risk items, and we will cover the summary and key insights. So I hope you liked the analysis, and I hope you liked all the things which we have covered even in last 2 years. So if you have liked it, I will request you to subscribe to the channel, like this in the comments. Put your comments if you are interested to see the next part of the video, which is for valuation and risk. And I will see you again sometime soon. Thanks for your time.